year. The global economy slowed down a little bit, and it was a bigger deal for the developing world. It happened because the European region had been growing about 2.5%. They stalled. What you're hearing, you know, what we're forecasting this year is that the European region is going to be accelerating gradually. So you're going to get moderate growth this year. I really think the Italian election is a reminder that Europe's kind of tired of the austerity idea, and I think that the important signal to me is that it's beginning to send a signal that it's not so smart to try to fix a deficit that was caused by the recession. And this is really what Europe's situation is very much like ours. Europe had deficits. Their deficits were basically, they'd met their targets, their Maastricht targets by 2007 before they went into recession, except for Greece. So everybody was on a sustainable track. And I think what we're going to see this year is a moderate improvement in Europe. On the couple big stories that are going on that are playing out, as you'll see them when you're in the middle part of the country. Manufacturing, the lights are coming back on again. It's for many reasons, but a big reason is the trade-weighted value of the dollar is the lowest that I can ever remember. It's the lowest in my memory. It's the lowest in my books, in real trade-weighted terms. And this is the main reason why companies, what that means is it's very attractive to locate here in the U.S. Manufacturing is different than it used to be because of all the innovation that took place, but there's a lot of new jobs and a lot of new opportunities in manufacturing, and this is going to be a big story in contrast to what we saw in the last decade. The gas shale story, it's huge. It's a huge deal. It's changing the way we think about energy. It's driving a lot of economic energy. We have not yet seen it play out. There's huge incentives here to rethink how we do energy. When oil prices are $100 a barrel, natural gas is $15 a barrel, everybody has an incentive to rethink what we're doing. And finally, when you've got the Fed doing what it's doing and they're making it real clear what they're after, the Fed overnight rate is 0. The reason they're buying assets is because they're trying to drive long-term interest rates down, and we should know this is not forever. Let me just give you a quick idea on how to think about the interest rate environment. When the Fed buys $2 trillion of assets, takes them out of the market, the purpose of it is to drive risk-free rates down. They did this because they couldn't get the funds rate below 0. We should know that what they're doing is an aberration. It's not forever. We should be viewing today's environment as a window of opportunity for financing. I see the opposite going on, and everybody's still deleveraging. And I think the way to think about how big is this distortion is look at the nominal 5x5 Treasury yield. So the interest rate that the market thinks is going to be existing for 5 years from now. So you get past what the Fed is doing right now, the promise it's made about keeping interest rates at 0 till unemployment comes down. The blue area is the thing to think about. This is what's guiding most economists when they think about, well, how much will rates rise if the Fed stops buying? The blue area is the real rate of interest, the 5x5 TIPS yield. And what that tells you is, real rates tend to be about 2 to 3% historically. But since the Fed has been doing what it's been doing, the real rate has been coming down to about 0. So that's having a powerful effect. It's incentivizing investors to move money out of cash, move into risk assets. That's one reason why you're seeing such a strong recovery taking place in the auto industry. They're almost back to normal times. So, you put all this picture together, and I see a future that looks like it's got a lot of growth, because we in the developed world still have a long way to go to get out of our recessions. I think we're halfway out. But in the developing world, there's just a lot of growing to do, and it's clear what they're trying to do. They're trying to catch up to where we are, and we're happy to help because there's lots of opportunity in that. So that, structurally, this makes me very optimistic about the growth outlook. So I'm going to stop there, and if we get time for a couple questions, I'll. Okay. Yeah.
In your chart where you're comparing the relative growth between the U.S. stock market and ex-U.S.
Yeah.
The rest of the world. If you had money to invest today, and you know that we've come all the way back from pre-recession numbers in the U.S. and the rest of the world has not, where would you put that money today? Do you think there's more upside ex-U.S.? And let's leave Europe out for now because Europe has its own issues going on. So let's just talk about BRIC and compared to the U.S. Where would you put money today?
See, I'm an economist, so I'm going to tell you, only what I, as an economist, would do. I'll tell you the same story I would have told you 10 years ago. I've always heard heard strategists say, oh, Americans aren't diversified enough, they should be, the world has got a lot of opportunity in it. My feeling always was, no, we don't need to be, because the way the world is developing and opening up, it's open to everybody. So I feel like if you're investing in Latin America, or you want to invest in the Asia story or the European story, invest in American companies. They're transparent, I understand them better, we have, rules that we understand. I really think we're all safer and better off to be investing in our own companies, because large or small, they're all participating. Starbucks has got a whole new universe opening up in China. They didn't think that Chinese would ever drink anything but tea, but there's all kinds of stories like this, and it's because the China story, less so India, is kind of open to the world's community of businesses. So I really think I'm not smart enough to figure out how long it's going to take Europe to get its act together, but I think our companies are going to figure out we're hungry for growth and we're hungry for opportunity, and that picture that you see on Profits just tells you people in the business community know where these opportunities are. I trust our folks to know better where to be investing globally. Yeah.
Question on sequestering. Microphone.
Yeah.
Question on sequestering. Good or bad for the economy this year, next year, and the future years?
Not helpful. It's a ridiculous thing to do, because to have a blanket cut of everything, the smart thing to do, and they all know this, both sides will tell you this, the smart thing to do would be, if you want to cut spending, give people the ability to choose what is the most efficient thing to do. So this is we did it this way because they all thought nobody would ever do this. But the truth is, my feeling is, this is the fundamental problem. This is an economist story. The problem is not what you see. The problem is not today's deficit. Today's deficit is the result of an economy that stumbled into a bad recession. Go back to 2007, our deficit was 1% of GDP, and that was with financing Iraq and the New Orleans recovery. We were not talking about deficits. Our problem is what we don't see yet. Our problem is the entitlement programs. And that's the reason I'm optimistic about where we're going is for two reasons. I always told myself you couldn't expect that we would ever get a grip unless a politician stood up in public and said, we need to rethink our entitlement system. Saying we got a problem is the first start. Secondly, you know that a deficit problem, there's only two ways to solve it. You either raise taxes or you cut spending. What we learned, to me, that was the meaning of the tax agreement. What McConnell and company did by extending Bush-era tax cuts forever, even Bush could not get that. And what that told you is it sort of affirmed what you already know, that the American public is not real enthusiastic about paying more taxes. And what that means is it forces the debate on this issue in the future to go back to spending, and the only way to really get a grip is to try to figure out how to reform health care and the Medicare system.
I think we have time for one more. One more.
I'd like you to address, you pointed out a number of issues that are positive. I'd like you to address the issue of Medicare. I'd like you to address the issue relative to Obamacare that's coming down the pike, the tax issues, the policies towards energy and financial policies that are coming down that are going to affect